today's faculties.
Welcome back to the last session and a very important panel on valuation. So we have a very erudite panel here. First one to be introduced is CA Yusuf Hakim. He's a partner of the firm CNK and Associates LLP, and his focus area is business and transaction advisory and indirect taxation. He's also co-authored a book on NBFC regulations on behalf of BCAS. Thank you. Second panelist is Darpit Kanadia. He is having 14 years plus experience in valuation. He is a partner in Desai Haribhakti, handling the valuation division. He has gained experience across various industries like infra, media, agrochemical, steel, retail, information technology, e-commerce, consumer products, pharma, and automobiles. Oh, it's a huge list. Our third panelist is CA Pinkesh Billomoria. He leads the valuation and modeling practice for Deloitte and has an experience of 25 plus years in valuation. Thank you so much, sir. And the last panelist is CA Snehal Pawar. She's a director of valuation services at KNAV, and she has a valuation experience spread across an array of industries with focus on portfolio of private equity, venture capital, including edtech, fintech, retail, etc. Thank you so much, ma'am. And our moderator is CA Devarajan Krishnan. He has more than 15 years of specialized experience in valuation advisory services, and he is a partner at Icon since 2014. Now I would request CA Sanjay Nikam to present a memento to all the panelists and welcome them all with a loud applause. Okay. First is Darpit. CA Darpit. CA Yusuf Hakim. CA Pinkesh Billomoria. CA Snehal Pawar. And moderator CA Devarajan Krishnan. Thank you so much, everybody, and yeah, the entire thing is now yours. Thank you.
So hello. Am I audible? Good evening, everyone. So generally, everyone believes that in any such seminar or conclave, the post-lunch session is what is most difficult, right? I think, but more than the post-lunch session, I would say in a 2-day conclave, the last session is even more difficult. I can obviously see many more hanging around here, but it is generally a challenge to keep the interest of the audience motivated till the last moment. But I think today it might be slightly different given the kind of panelists we have with us and the kind of experience that they bring on table. I think it's all of you here are possibly going to take up a lot of value add on your knowledge by the end of the session, and I can assure you that. I've worked closely with most of them in a professional capacity over the last so many years on the valuation domain, and the experience that they bring on the table is possibly something that you should take away. Also, I think they will agree with me that although it's a panel discussion and it'll be more of a Q&A between us, all of you at any point of time feel free to kind of pitch in with your questions or with your experiences or any challenges that you have faced which you want us to throw more light on. So on that note, let's start. And So before we get into specifics, what I would say is we've kind of tried to divide this session into a few buckets. Initially, we'll speak about a couple of sectors in which M&A has been recently active. So we'll focus on 2 sectors, and then we will move on to the more aspect which everyone here is more familiar with in terms of regulatory aspects of valuation under M&A, and we'll also touch upon valuation requirements under the financial reporting domain. So that's how broadly we'll kind of divide it. So see, whenever we talk of M&A, right, the first thing that comes to everyone's mind is certain trends that are happening today. Which sectors are more active in M&A? What is the size of M&A? And those kind of things, right? So one of the sectors that you would actually see it's quite active now is actually the cement sector, right, where there's a lot of activity happening in terms of acquisitions and mergers and things like that. So I would like to start with maybe bringing in Yusuf here as to, for his views on a lot of consolidation happening in the cement industry. Why do you think that's happening? Yusuf. Yeah.
So, I basically think that the consolidation is essentially a market share game. And today, if I just give you a few statistics, the total annual installed capacity that we have in India is about 600 million tons per annum. The actual demand is only about 425 million tons per annum. So most of these cement plants are today functioning at about 60 to 70% of their capacities. Maybe the larger players are doing slightly better. So the question that I had when we were looking into this entire sector was that why is it that today people are still, and if you see a lot of consolidation, I think there have been at least 15 or 16 acquisitions since 2016 only in the cement sector. Adani has started virtually from zero, and they have now built a capacity of almost 90 million tons in just about 3 years. So that's the kind of scale that one is looking at, even though they are not able to utilize their production capacities very efficiently. So I think the idea is very clear. The larger conglomerates want to grow bigger and bigger. They want to sort of wipe off competition, or at least the smaller players, to the extent that they can, and consolidate the presence in all the 5 regions. So that's the basic factor that is there. I think the second other important factor is obviously with every acquisition comes the benefits of the economies of scale. And I think that's the piece also that they are trying to bring. So when these large conglomerates make these kind of acquisitions, not only are they sort of, getting that benefits of economies of scale, but also the synergies come along with it. The third and the most the other important reason is, in terms of our, cement requirement, India today is the second largest cement producer in the world after China. We are also the second largest consumer in the world. So that's the demography that is there. The fourth reason is, the fillip by the government on infrastructure projects. So you have, you see the kind of roads and highways that have been built over the last just couple of years, and you'll see how, this has taken off. So, today itself, I think I was reading the papers in the morning, and there was an outlay of some 29,000 crores in the infrastructure projects. So it's the government also that is giving a huge fillip to infrastructure projects that is, taking a surge in the demand. Then obviously the, the affordable housing scheme under the Pradhan Mantri Awas Yojana or the Smart City mission, all this is sort of going to drive up the demand for cement. The other thing is today the real estate sector is doing very well, and you see practically new buildings or high rises coming up by the dime and dozen. So that's also a reason why, there is going to be an uptake in demand. The only challenge as I see from, is that today, why would anybody not want to utilize the existing production capacities more efficiently and sort of, get into adding more capacities? And the only answer to that I can think of is because they want to do the consolidation game and sort of, not have these smaller players in the market. So,
yeah, Pinkesh, you want to add something on that, on why do you, see a lot of consolidation and M&A activity again picking up now in the cement sector?
Sure, thanks, Yusuf. I think most of the points that Yusuf mentioned captures the ethos and the background why a consolidation is happening in this. For that matter, you can look at multiple industries where you have nationally 3-4 players who rule the roost, who corner maximum profits, and then rest of it remain as SME level. On the same basis, if you see the cement or the building industry or building materials industry, it's very fragmented, very fragmented. If you see last 4-5 years, you see a lot of consolidation. And the reason is also a lot of larger players have come into play, whether it has started with, of course, Birlas, then JSW joined in. Of course, Adani Group acquiring Ambuja and ACC was more recent. But that brings a lot of push and flip to the whole sector. The very idea of consolidation in any industry is to get scale, increase your market share nationally, and that only determines your profitability. Really speaking, in this commodity business, if you don't have the right scale, market presence, operating synergies, which is very important in this particular sector, you are not going to rule the market. You cannot influence the market price. That is determined by market forces. So how do you do it? Over the period, you can capture a lot of market share by acquisition, by adding capacity organically, inorganically, only with an intention that after a few years, you will be able to control the prices, influence the prices, which is what has happened in the cement industry as well. I would look at it in 2-3 ways. Wave one, when Birlas were very active and they acquired a lot of assets, plants, mines in this business, and they acquired it from either from the government or from even private players. So that was first round. And in fact, if you remember, Lafarge came to India, Holcim came to India, Heidelberg came to India, Water&Tim came to India. Some of them are there, others have left. So the consolidation cycle we can see. People from MNCs have tested the Indian market and they've decided to move out for various reasons. The second piece is also when the banks were under stress because the companies which were not able to pay back, they induced a lot of these companies to hive off their assets, monetize some plants or businesses. And we've seen multiple of those companies pre-IBC also and during IBC cases also. So that was another way wherein because of the bank's push, a consolidation did happen. The third and the last one I would say is when a new player like Adani Group with a lot of investment and play in the infrastructure space acquired the Ambujas and the ACC and thereafter did bolt-on acquisitions right across. They're planning to do it everywhere in terms of adding capacity both at both the companies, acquiring Penna, Sanghi Cement. They're already, if you read negotiation on the newspaper, Orient Cement. So the intention is very clear. The idea is to take something which is very fragmented to consolidated position, national presence, improve the pricing and corner profits, so, which is a normal one. So this is how I see the consolidation happening. Like it would have happened in any other industry, this is what I see.
Right. So I think one takeaway that I actually can gather from both the responses is that you may do a valuation of a cement company or of any company for that matter, but the value that you add really is going to come from the understanding of the business, understanding of the industry, understanding of the trends that are happening in the industry, the reasons for that, and why certain things are happening. Right. That's where you're going to be able to understand the business and the industry much better, which will help you actually value those companies. On that note, let me stick with Pinkesh in terms of valuation of cement companies. So, as we all know, cement is a sector where there is a lot of M&A activity, but a lot of these activities are also sometimes restricted or focused on certain regions within the country. Even from a valuation perspective, it's a bit different sector where you will have to see things like what is the capacity, what is the geographical location of the target being evaluated and things like that. So I'd like to pick Pinkesh's brains on specifically while valuing a cement company. What are the specific aspects that you would tend to look at in terms of analysis in addition to what you normally do in any normal business? Pinkesh.
Thanks. So I think valuation of any business or any company would be on a very similar basis. Income approach, market approach, and worst case also look at minimum of the asset approach. or the future cash flows that you generate. I think the nuances that needs to be considered while evaluating a cement company is first and foremost is to understand the underlying subject company, what is actually. It's very easy to say it's in the sector of cement sector or building materials, but within that, what all do they do? Whether it's an integrated play, whether they have adequate mines, adequate resources, clinker capacity, and to back it up with a grinding capacity. So, and two, in which markets do they operate? Typically, if the way we read the markets are, if you are in west zone, if you are in north zone, the demand is good and the pricing is better for this commodity. But if you are in east, maybe the price is good but the volumes are restricted, which is not the case in south. In south, the prices are down because there's already overcapacity built up. So then you cannot push the prices. So depending on the location of the plant, the market that you address, the second lever is on the operations side. It's a very highly power utility requirement business because a lot of power utilities are required. So if somebody is able to operate a plant, even though it's in the same area, but more efficiently, they have their own captive units. If they have put up some, let's say, waste heat recovery system, some more ways of salvaging the byproduct and monetizing them. And third element is on the logistics. Even with the same example, it's a heavy product, it's not easy to move. So the logistics and the location of the plant versus the location of the target market is very crucial. The moment that mix is perfect, the profitability is best, the earnings per ton or earnings per unit that you sell, the unit economics are best, and so you could attribute a superior premium to it, vis-a-vis a company which is, or a plant. So this applies to even within a particular company. If it has 5 plants, whether 2 of them in north, 1 in west, 2 in south, you would evaluate each of them separately rather than looking at the overall level, because it's misleading to do it on a broader basis, because the economics, profitability, the target market, the market price that you could command in there is quite different. So while what happens is you generally look at the cash flows, the market multiples, then from a communication perspective, what happens, we say, okay, EV per ton, $90 for one deal. It could be $150, while some of the listed companies can be more than $200 per ton. But that also tells you the story about how high profitability somebody is able to get, either because of the market presence, the realization that they're able to do, and the efficient operations. So these 3 elements are very important. While it is very common, we have multiple listed companies in India from whom we can borrow multiple, apply some premiums discount, look at the transactions, because in the last 10-15 years, multiple transactions have happened, whether by way of merger, by way of acquisition, or divestment, when Lafarge sold off, Holcim sold off. So you could look at it. Even when banks induced, let's say JP, to sell off different plants, there are benchmarks available for each market. So we could take cues from it. The second piece is also important when we look at valuation is the legal aspect of it. And reason I'm saying legal aspect of it, because companies have multiple plants across the states. They have mines. Whether the mines are transferable, what are the legal thing about it? Because few years back, the consolidation story that you're seeing today was not prevalent at that point of time, because there was a question mark on the transferability of the mines, which is there. Since there is a clarification that had come out from the ministry, you see more transactions. So these are other aspects apart from legal disputes which important for us to keep in mind for the valuation.
So which means, is it fair to say that if you're evaluating a company with a plant in a specific geography, for this cement sector at least, you would tend to look for, comparables or other peers more in that similar geography rather than anywhere across India?
Absolutely.
Simply because of the business dynamics that you explained.
Absolutely. So as I mentioned, even in one company, if you have 5 plants located differently, you would have to evaluate on their different regions, because the profitability, the pricing that they realize are very different.
So the market dynamics of that geography are very different, which is going to determine how you deal with each of those plants in each of those locations. In terms of peers, let's say projections, margins, whatever it be, all of them would be unique to that geography then.
Just simple example. Ambuja is the holding company
Right,
with its own operations. ACC is also an operating company.
right.
But if you see their profitability for each of the plants or on an overall basis, their multiples, EV by tonnage or EV by EBITDA, are quite different, because their expected profitability going forward is also different.
Right. So that's something
that's
that is
that's
unique
very
to this
clear.
industry, right?
That's very specific to this industry,
Yeah.
unlike an FMCG or some other services,
That's right.
which is not
Where you can look
geographically
at any
agnostic.
listed company in India in say FMCG and look at benchmarking that against another FMCG company that you're valuing. That's not possible in a sector like cement, and that's because of how the market works in each of these locations across India. Yusuf, you'd like to add anything on specific things that you would look to analyze additionally when you're valuing a cement company?
So I think he summed it very well. And I would just like to add a couple of points to this entire thing as I've understood the cement business. Firstly, there are different grades of cement that you're looking at. So, typically there are 6 grades of cement which are there. They are divided into blended and unblended cement. Now, the unblended cement, is not, it doesn't use limestone. It basically uses fly ash or slag, which obviously reduces your cost of production. So that's one very important factor that you need to look when it is the raw material costing. And I think now a lot of them are selling this blended, cement in the market. So that's one factor. The other thing, and I think Pinkesh rightly brought about, is the fuel and power cost. So if the company has, a captive power plant of its own, then it's obviously much more cheaper because that reduces your power cost to a substantial extent, and that obviously gives you an advantage over your competitors. So that's one thing. The third, and if you see the other major component of the cost, it is the freight cost. Now, typically speaking, in a cement industry, your freight cost is as high as 25% of your total operating cost. That's a significant portion. Now, really, so how do people manage this, transportation cost? Is basically they will have so you have a choice between an integrated cement plant versus split units. So you'll really have your cement plant which is closer to the raw material side. That's typically the way that it happens. And you have your grinding units which are closer to the end use or the market, so that you bring your logistic cost, because cement is a very bulky item, and if you were to transport it over long distances, it becomes economically very costly, it becomes unviable, to be frank. The other thing that you need to realize is that the prices of cements, across these grades, so within a particular grade, whether it is an Ambuja, whether it is an Ultratech, the prices are more or less in the similar range. This is a very price sensitive commodity that is there. And that is one factor that, that one needs to keep in mind, because you cannot do a lot in terms of your average realization price because it's controlled by the market. It's not in your control. The only control that is there in your hands is to manage your operations efficiently, and really speaking, how you manage your fuel and your freight cost becomes the key driver for the valuation of this business. So I think Pinkesh rightly brought out these facts as well. And apart from the 3 normal approaches, the replacement cost becomes typically your floor. So effectively today I would say that, okay, how much would it cost me to set up a plant of my own, a greenfield cement plant of my own? So I mean, if you go to history, it says it will cost you about $100 to $120 per ton. That's the basic thing. Added to that, you take the timelines for getting all your approvals, your licenses from the government, it becomes that much more costly. So today, if you see the deals that have been done, and I'm talking about the recent ones, for example, the India Cement, when the Birlas acquired that 23% stake, or even Ambuja acquiring Penna, the deals were priced at roughly about 89 to 90 US dollars per ton. So that sort of gives you an idea as to, it's cheaper that way, you get a head start. And also from the fact that you don't have the long gestation period. So apart from your market approach, which is, for traded companies, obviously, for listed companies, you would need to go with the SEBI traded price. You have the comparable companies method or comparable transactions. You may not want to use that depending upon the information that you get, and sometimes, at least for listed companies, it is price sensitive, so they may not want to share a lot of information. But depending upon that, you'll have to choose which methods you can sort of choose, and then do that. Listed companies normally, I think, they don't prefer the income approach because they have to share future projections, and most companies are not willing to share it at that point of time. So you have to choose between the comparable companies method and of course the traded price.
So which means you as valuer can actually draw a lot of comfort from thumb rules like replacement cost, like you said, right? Even if you're using the traditional methods, you would tend to look at things like a replacement cost to see how much does that come to, as to if the buyer were to kind of do all of this on their own, how much would they end up spending? It's more of a buy versus build kind of decision. And that will also help you determine what is the reasonable value which you as a valuer can also justify, right? Yeah.
So it's a perfect corroboration or a cross check, because on the face, when you look at a valuation of a company, you will come to know $90 of the last deal. But there are three plants. Something could be 121 and something at 80. So as a benchmark, does it match the corroboration for that particular market? That's a good benchmark.
And this approach, although EV per ton, like both of them mentioned, is possibly something that the cement industry looks at. This concept can be applied, I believe, to any industry, right? The metric that you evaluate it on might be different. If it's instead of cement, it is in hospital, you might actually look at an EV per bed kind of scenario. If you were to set up a hospital of so many beds, how much would you actually end up spending, incurring to build it? So as a concept, having these thumb rules like replacement cost actually help you as a valuer to determine what is the reasonable range in which the value should lie. And that is going to help you support your conclusion from income or market approaches, right? So Yusuf also kind of mentioned earlier about how this sector is related to various other sectors, right? Real estate and things like that. Now, one trend that we've seen of late is cement companies more and more getting into businesses like paint. All of us, I'm sure, have seen a lot of ads of Birla Opus recently during the matches. Even JK Cement, for that matter, has gone into paints business recently. So, Darpit, I'd like to bring you in here in terms of this trend that is observed recently, where cement companies are specifically getting into paints business. How you look at that trend, and if at all from a valuation perspective, does it pose any specific nuances for you?
Sure. I think just to continue with the cement discussion, I think if we look at the current differences between one company of cement or another cement company, you look at power cost and logistic cost, that's given. But I think one of the important success mantra of every cement company would be also having a robust dealership network. I think if you look at the established players, they will have very good dealer network. And just to further elaborate is the consumption is like 1/3 in residential, 1/3 is infra projects, and 1/3 is commercial and factory. So, this is the, cement industries. And let's go to the paint industry now. And, okay, just to give a macro idea, right now in India, the paint consumption is like per capita 4 kg, whereas in USA it is 16 kg. So there is, 4 times difference. At the same time, if I look at cement, it's about 250 kg and US is 350 kg. So it's 1.5 times. So now if cement companies wants to look at growth, this looks a good, interesting area. Now let's go to paint industry. Erstwhile, the paint industry was dominated or, more, and the reason why today also it's dominated by the main 4 players is because there was a huge cost of inventory. They used to keep the different 2,500 shades of inventory in all the dealership network. But the most interesting thing happened was the tinting machines. The tinting machines now allow all the dealer to just, tweak the colors based on the base colors. So now it has become asset light and it's become easier to penetrate paint industry. So let's say to set up a paint factory, it's about 100 crores maximum if you see the investment they are doing. And that's why you see cement players are finding it exciting to enter the paint industry. They will use the same dealers who are interacting with the same architects who will do paintings. They will go and ask them, okay, you are taking my cement, you take my paints also. Like Birla Putty is very common. Now, obviously, the encouraged signal would be, okay, go into paints and start selling Birla paints. So that's one of the most fascinating reason. And if we look at tinting machines also, Asian Paints has about 50,000 tinting machines, and whereas the other competitor combined together also are, I think, less than that. So that's one change that you will see. The second interesting fact is the return on equity. Let's say the EBITDA margin enjoyed by cement guys are about 25%. But the return on equity, because of the higher cost of asset, the return on equity is in the range of 15%. Whereas in paints, I think Asian Paints is having 25% margin, but the others are having 20%. Still, the return on equity is around 15%. So what the cement guy is saying is, okay, I'm facing cyclical issues during the rainy season. I would find a better synergy with the paint sector. It's having a very similar brand recall value and also dealership value. And that's why you see, even this is very similar to, let's say, even Astral Pipes entering into paints, because they are also having a similar dealership network, similar consumers, so they find it easy to enter. And probably this is likely to grow only. Even Shree Cement is saying, I want to enter paints. JK Cement has already acquired. Piramal is also looking to enter in spite of being in reality. So it's something which is going to change because of that. I think the tinting machine is a disrupting factor which is affecting this.
So it's a classic case of both factors. One is the requirement to grow exponentially, which might not be there in cement. So you tend to look at something that is connected to us as close as possible, and you get into that. And second is, of course, to hedge against the other challenges you're facing in certain seasons in your current business. How do you hedge that effectively, but in a related industry and not unrelated? Yeah, Pinkesh, you want to add?
Sorry, just to add, Darpit, you put up the facts very nicely. Just to add, what we have seen in various other businesses is creating a platform where your set of customers should be able to buy out each type of product. So one, it was only building material where a person or a dealer would buy cement from A company, steel rods from C, or paints from another company. Now that is all going to get into one single unit platform, which is like what has happened to other industries and people have created. It's more to serve one set of customer with all the typical products that he needs to buy when he is setting up or constructing something. So that's how I think I'm looking at, whether it's a heavy industry or FMCG or services, it's all becoming platform.
And I think another interesting part of paints is, let's say, cement and a paint guy. I mean, residential today the trend is that you will renovate a house, once in 7 years, where you use cement as well as paint. But painting is actually more common. So they see that it is happening every 3 years, and that's the exciting part. Now that trend is also coming better. Everybody wants to renovate their house more often, and cement guys are finding it more interesting to now go into paints so that they get more revenue generation opportunity.
Right. Yusuf, you have anything to add on that?
So completely agree with both Darpit as well as Pinkesh. I just want to add a couple of points. See, it's typical banya buddhi, as simple as that. जिसको cement लगेगा उसको paint भी लगेगा. Now you already have a ready distribution channel in terms of your customers for the cement industry. If you are looking to sell paint to these customers, you are taking advantage of the cyclical thing of the cement industry, and that's the biggest factor that is there. Secondly, if you look at paint today, the dealer distribution is the most important factor. Particularly the contractors and the painters play a major role in deciding which products of the paint industry to sell. So effectively, if you tie up or you acquire a paint, not only are you sort of acquiring their distribution network, but you also have the opportunity of selling cement to their customers. So it's a very good cross-sell in that sense, because both of them are really complementary products. And I think that's the biggest advantage of why a cement manufacturer would look at the paint business. By the way, I feel that none of these businesses are for the faint-hearted. I mean, really, if you look at this cement, the risks are far too high, and I'm sure Pinkesh is smiling over here, so he probably agrees with me as well. I mean, business is cyclical, price wars are there, cost factors are there, and to mitigate your risk, you would look to diversify into a complementary product which you can sort of offer to your customers. So I think that's the basic business logic that looks available to me.
And we as valuers, the best we can do is be in the role of a valuer, right?
Well, it's not for you and me, so we can only play the role of values.
Right. You want to add
Pinkesh,
something?
you want to add something? Because
Yeah,
you're
you can.
smiling.
Please feel free to add.
I was saying, in fact, it's understanding a business is the most important part of valuation.
Yes, absolutely.
So that's why whether we are focused on 5 sectors, 6 sectors, but we ought to know that the key risk areas, key value drivers. Otherwise, whatever is the outcome is going to be bad.
Absolutely, couldn't agree more. So I think we've covered quite a fair bit of the cement sector. Before we move on to the next sector, I would like to kind of break it up a bit and be more generic. So we all are talking here about valuation in M&As, right? So I would like to cover, a few minutes on how do the panelists think that when you're valuing, let's say for the purpose of a merger, as compared to when you're valuing for a non-merger type of transaction, a simple fundraising, right? What are the different nuances that a valuer has to look into, and why do you think there are differences in both the approaches, if at all any? So we can start with Pinkesh and then move to the others. Yeah.
So I think merger is one of the perfect ways of acquisition whereby 2 set of shareholders and companies agree to come together, enjoy the benefit of the future potential, adding forces together. It could be for various reasons: survival, turnaround, increasing market share, creating a super lead on our market share, or acquiring or doing something from a global markets. So like Tata Steel acquiring Chorus or Hindalco acquiring Novelis. It's quite possible. Now, typical of merger is one can look at it. And when I move from an acquisition to merger, how do you look at it, or what's the difference? It's very, very unique in that sense, coming together of forces. 2, it's a non-cash, which is most important, where people will have patience to be in the business. Nobody's exiting the business. Parties are coming together, leadership teams are coming together with an intention to grow this. So 1 + 1 is just not 2 for them. With the synergy, with the benefit, size, scale, benefit, it's a re-rating game that people also expect. So survival could also be there, like the telecom companies, we saw 2 of them merging. So this is very important. Non-cash, which is very crucial. It also gives a time. If rather than paying out cash and acquiring a business immediately, you could merge it and maybe after a few years give that exit. So these are the important points. Apart from this, timing. From a timing perspective, when I look at it from a pure play acquisition of a business or a shares, it does take a little more time than a normal business transfer agreement. But the benefit in terms of getting a code blessing, NCLT blessing, helps a lot in your contractual obligations, in your approvals, and with various state authorities and others to get a clearance on the merger. So people do take some of the schemes which could have an option to not go through the merger route or the NCLT route, to go through that with a lot of benefits. In case if the merger route is to be considered from a valuation, there are certain nuances. Since it's a relative valuation of company A vis-a-vis company B, you do KPIs of both the companies and evaluate who's stronger, what valuations come out, then peg valuation parameters which peg for company A, and then on a relative basis. We are not here to do absolute valuation. In a merger, we are doing a relative valuation of company A vis-a-vis B. And so to that extent, since partners are going to come together, stay together and grow the business jointly, there's a little lesser stress on fighting on the valuation numbers. So I can say that. However, from a perspective, in case if the merger is with a pure play acquisition assumption, that the route I adopt is a merger, but it's a pure play acquisition, and the incoming company shareholder will become a very small or a minority shareholder, then I have to still continue to use the valuation approaches like a pure play acquisition, but in the route of a merger. So to that extent, some nuances are there. Now, these are applicable for all the companies, whether listed, unlisted. But in case of listed, even if it is one company which is listed, there are certain nuances, SEBI regulations that one needs to keep in mind. And also, the interest of the minority shareholders also becomes a prime thing. These are the factors that one needs to take, and that's the difference between what I see between an acquisition versus a merger route that one follows.
Sure. So, Snehal, let's get you in now. So, you've obviously done valuations for so many years. So, while valuing a company for the purpose of a merger, what are the different challenges you face, or what is it that is different that you do in a merger valuation as compared to a normal valuation?
So I'll take this question more from an acquisition point
Sure.
of view, because again in the PVC industry, which I've looked at more, we see that acquisitions are happening like a step-up acquisition sometimes, and the goal here or the objective here is to eventually take it to an IPO, and an exit is in there. So that's from that particular example I'd like to take this one. Here, there are investors who are coming in with an intent of investing at an X number over a period of ballpark 5 to 7 years, depending on the stage where the company is at. They will be looking at an exit, going IPO. The valuations that I look at, and at every stage, they keep on changing. Because the narrative changes. The stage where the company is at when investor A came in, and when there'll be different series that keep on happening. The valuation here would change because the narrative changes. Of course, the number changes. What also sets this apart is who's driving this. The founder, who's the team, when it started, and how are they reaching the vision that they had from day one? Are they taking any detours? Are they pivoting from a plan? Because they also have to adapt to what's changing around them. So from a valuation perspective, as a valuer, what we need to see is track how the story, how the vision changing, how the milestones are achieved or not achieved, who's entering, what's the goal of entering, because an exit can also be an M&A exit, not necessarily an IPO. We've also seen recently, specifically globally, more in the US, they're looking at SPAC exits. It's a special purpose acquisition company, and they would want to go IPO that way. So different routes. Over time, like I said, the valuation methodologies will also keep on changing with them, because initially, because you could be pre-revenue, and the way you would look at the company is very different, as opposed to you're more mature. There'll be more mature companies, then you'll have at least more information available in the market. So valuer has to sit back and think from all those perspectives, where the company that they are valuing is really sitting at, and how reliable are those observable or unobservable inputs. So I think that's what sets apart from a more mature merger, if they're looking at two more acquisition stage kind of transactions.
Right. So Professor Damodaran always says, right, valuation is not only about numbers. It's about the story that you tell along with the numbers, and that's what she kind of covered very well. Yusuf, I'd like to come to you in terms of your views on what are the differences in a merger valuation, or what are the unique aspects of a merger valuation as compared to the others?
So, what I think is, and I think Pinkesh summed this very well, the real reason why you would go for a merger is, firstly, you want to make it a larger conglomerate. So today, two companies are getting together, they want to sort of scale up in size, and the management sort of gets divided between the two entities. But and the other reason really is that even if when two companies are merging, the companies may not, one of the companies may not want to continue in the management, but they still want to get the benefit of the upside going forward. They don't need the cash immediately. So that's the real reason why they are sort of saying that we'll go for the merger. So for example, we did this transaction of the ABB versus Timken. And there it was exactly the same point. The promoters, ABC merged into Timken. Timken shareholders, the ABC shareholders got shares of Timken. And the promoter said that we don't want to sort of continue in the management. So that was the whole logic. But effectively, and they said we have the financial wherewithal, we don't need cash immediately. We will benefit from the upside of Timken shares. So that was the very clear logic. The challenges that I foresee, when you are doing a merger versus an acquisition, obviously you're valuing two companies. Now, what is the valuation methodology that you will adopt for both the companies? Because both will have different dynamics, different things that are there. So that's one aspect that you are dealing with. Secondly, if you are looking at the income approach and each side wants to get a better valuation, I mean that's a given. The question is, if you're going through the income approach and you're doing DCF, how much will you rely on those projections, or what is the kind of sanity check that you'll put on those projections as a valuer? To me, that's a very, very challenging factor, because that's something that is going to be severely contested by both sides. Because if it's in favor of one, it's not going to be in the favor of others. So I think, to me, the biggest challenge is to align these interests, in terms of valuation, particularly when you are using the income approach. And that's the key.
Right. So although it's a relative valuation,
It's
what
a
I hear
relative
is that
valuation.
that's something that is sometimes more challenging than even an absolute valuation, right?
Correct.
Because of the finer aspects that you mentioned.
That's
Right. Darpit, you may want to cover some of your experience.
Yes.
Yeah.
So I think that I just add in the income approach part. It's when we're doing an acquisition valuation, what happens usually is one party is trying to exit, and the other guy wants to. In the case of merger, it will be usually both the parties want to have a very ambitious plan, and both are merging together in the future. Now, as a valuer, when you are doing the income approach, it's very important, and you're interacting with two different management. One may be more ambitious while giving the projection, one may not be the case. So it's very important as a valuer that you bring that balance when you are valuing both the companies. It has to have a very similar or uniform principles, and you need to have reasons why one company, if at all, is going to grow further or faster. Then all these things needs to be documented well, and that's common for whether it's listed or unlisted entities. Now, if it gets listed entity merger, then again we need to be very mindful of the SEBI regulations. Like even the valuation date is kind of decided in a way by the date on which the board meeting happens, depending on the type of valuation. Also, the minimum price is determined based on the SEBI requirement. Also, there is a very given format of what are the numbers to be given as per income approach, market approach, asset approach. And in fact, these days, if you see the checklist of the revised checklist of NSE and BSE, so to say, they've even covered the list of comparable companies, the list of the workings behind DCF, the reason why income approach or the how is the valuer justifying the projection growth as well as the margins. So this is the new development that's coming in. Further, I would also put across that there is a circular last year where they've said that if you want to apply income approach or market approach, the unlisted entities and listed entities financials should be audited or limited review. Again, all these nuances are very, very specific to a merger valuation. When you're doing an acquisition, probably the aspects are relatively different. So
if I were to sum up what all of them said, basically, if it's a normal valuation, one client, one stress. Here there are two companies, double the stress. I think that's what they're getting to. Multiple. It's 1 + 1 is not equal to 2, like Pinkesh said. It's much higher, right?
Yeah, because merger valuation is highly regulated.
Right.
And historically, we have seen it's rooted in relative valuation, the HLL Tomco case, so many other cases. So a lot of high courts, Supreme Court would have their own views. And to add to it, we have proxy firms also to add to their views.
Right. So because it's a regulatory process, that kind of increases the scrutiny and also increases the kind of things that you as valuer need to actually look at and be mindful of. And like you said, proxy advisors are probably the latest to jump into that, where you have to be utmost careful, much more than what you used to be in the earlier years, because anything that you do as a valuer is going to be challenged, right? So that's something that even like he said, I mean, although you are not a person who's preparing the projections, but all the analysis on the margins and the growth and all of that, as a valuer, some kind of due diligence has to be done there to ensure that those are reasonable. So all those aspects kind of become double in case of a merger, and you need to ensure that relatively also all those aspects are kind of taken care of, right? Great. So now I think since we've covered the general aspects, again, let's move on to our sectoral discussion. This time, a little bit more modern industry will take up, which is more closer to new age. all of us have kind of witnessed the recent euphoria around sports and entertainment in the country due to various factors, including the World Cup and all. IPL is something that's kind of very famous. There were recent news articles which suggested that, you know, RCB, which is belonging to the UB group, contributed a significant chunk of profits to the profits of the listed entity, which is United Spirits, right? So I'd like to bring Yusuf in here, you know, how he sees his views on this aspect in terms of valuing, how are IPL companies valued, and, you know, is there a trend that we can see here in terms of their contribution to profits of, say, large conglomerates?
So, you know, before I get into the valuation aspect, I think I'll just give you a few facts and figures which will sort of make this thing clear. So first of all, IPL today as a business is valued at $16.4 billion. And that's the scale and size that you're looking at. Now, if you look at it in terms of profitability, you know, one is obviously, you know, the kind of profits that the companies have been reporting. And I can tell you that, you know, when we looked at the financials of some of these IPL teams today also, they are still making losses. So that's one factor, but I think the valuation is a different ballgame. You know, it's more about, you know, how the brand has been built over the years and so on and so forth. So effectively, if one were to do a valuation, you would need to do, I would presume an income approach. You will have to do a DCF. Now, effectively, you know, because most of these are unlisted companies, so you will, you know, that's the only way to sort of do it. Now, effectively, also understand the income streams and the costs that are there. In terms of the income streams, obviously, the main income comes from the advertisement and the sharing of, you know, because today when BCCI sells those rights to channels and, you know, the OTT platforms, there is a fee that those channels pay them, and that is shared amongst all IPL teams in a particular proportion. Then there are central sponsorships or ad deals, you know, in terms of title sponsors and all of that. So that's how, you know, plays an impact on the total numbers that you earn. Then there is obviously the ticket sales, the transfer fees, the prize money, the merchandise sales. So these are, you know, they've got 8 or 9 sources of revenue that they sort of keep earning from, you know, from these IPL tournaments. So really one has to look, because this is a larger game in the future. Today, in spite of, you know, companies not doing well in terms of profitability, their valuations are pretty high. Now, really speaking, when you are looking therefore at the company, you will have to do your DCF, and then you will have to sort of discount it at a particular rate. So that's the only way to do it. And I think the major factor will be because of the brand. And I think that's the major factor, whether it is the company or it's a brand valuation that you are doing, that will be a major component of the valuation. Now, if at all, I think one of the questions that you were asking, Dave, is that how would you value only the brand?
Right.
So if you were to sort of value the brand, then typically, you know, what happens in a lot of the leagues is that the brand rights are housed in one entity, whereas the actual operations are carried out in the other entity. So the team that is running the actual operations would say pay a brand royalty to the brand owning company. That is the way it sort of works. And I think in most of the IPL teams, everything is housed in one entity. So effectively, when you are looking at the brand valuation, you'll have to say that there is a savings in cost. So when you look at that relief from royalty method, you would say that typically, you know, when you are comparing other similar leagues, this is the brand royalty that they have paid on the total turnover. You sort of minus your advertising or marketing costs and promoting the brand that you incur, and you adjust it for tax, and that tax adjusted royalty is what you would discount over a particular period. Now, a lot of factors that are there, is, you know, how has the team performed? Okay, that has a bearing. Who are your market players? And I think that's the other factor that is there, because some of these players, for example, when you're talking of RCB, guys like Virat Kohli and you know, Glenn Maxwell, the crowds would throng just to see them in the stadium. So it typically depends on all of these factors. And again, we had that entire Bombay Indian fiasco. They didn't sort of do well, and overnight Hardik Pandya from a hero became a zero. Then again he became a hero after the World Cup. So you have all of this. So this sort of has a bit of an impact on your brand. So every year this thing will undergo a change depending on how the team has performed and who are your players for the next league. So that's how, to my mind, that you would sort of value the brand vis-a-vis the company. I believe that the brand valuation would also form a major component of the company valuation.
Which means there are many more other dynamic factors here in this industry specifically, like you pointed out, the actual performance of the sports persons on the field and stuff like that, which are something that you as valuers need to figure out how do those affect, the way you value these kind of companies, right?
That's correct.
Pinkesh, if I were to get you in not only on how maybe IPL companies are valued, but also whether do you think it makes a difference that the IPL franchise itself, for example, is owned by a large conglomerate, be it a CSK or an RCB, which are owned by large houses, or be it, let's say, a team like Gujarat Titans or anyone who's owned by a PE, right? So do you think those kind of aspects make a difference to, what is the valuation going to be of that IPL company, whether they're housed separately and not as part of these groups, or they're run professionally by a professional management?
I think there should not be a major difference to it.
Right.
Of course, the different categories of investors have their own expectation of return, which is why a P may expect much more, or their hurdle rate could be higher versus a strategic player, a large group. They may want it for a scarcity premium. There are only 10 of those franchises in India. You'll have that exclusivity club. So you pay a premium for that. That's separate. But ultimately, there are 10 franchises in IPL. For each of even the football league or kabaddi league, we would have franchises. Even there have been values, transactions which have happened for the same franchisee in the same league, but the values are different. So if all the 10 IPL franchises are not valued at the same thing. So there is a difference. So these ultimately goes back to cash flows. It goes back to what Hakim mentioned is the cash flows. Yusuf said cash flows is going to be key, but it also adds the how passionate fan base you have, what kind of star player you have, whether you have CR7, you have Messi in your team, or other players which actually attract a lot of commercial activity around it. Because whatever the star players bring is attraction on the viewership, on the advertisement, and building the brand. And in this story, in this current few years, it's all about Virat Kohli, Dhoni, and other star players adding their support, their fan base to the CSK and RCBs of the world, or Mumbai Indians for Rohit Kumar. So that is where we are in that phase. The second point is there are listed companies globally, not in India, but globally there are listed companies. Man U is listed, others are listed. So you could also evaluate from their side how they get valued sometimes, and there are transactions also which keep on happening for football clubs and all. So lot of it can also drive you from that understanding how a sports company, where it's asset light, there's no hard tangible asset being created. Success could be transitionary. But then on an overall basis, if IPL as a product does well, then the derivative of that in terms of the central income, central sponsorship, advertisement income is received by this franchisee, which helps them to do the valuation. So it's not, even if $16 billion IPL's valuation, it is not straight away divided among 10. Else every company's valuation would be more than its core business by its ownership. So these are the factors also which needs to keep in mind.
So very important point I think Pinkesh touched upon is something we call generally as barrier to entry, right? I mean, IPL is a limited market in its sense. Within the market, how much you capture, that's different. But if someone, in a classical example of a replacement cost, which we spoke of in cement, right? If someone were to put up a cement plant and build it, how much would it cost? Now, in IPL, the same thing can't be done. You have to go out and buy a team. There are no new teams out there for sale. neither can you go and build a team in an IPL today, right? So there is a clear barrier to entry, and that is something that you're saying in a way kind of tends to drive the premiums in the valuations that they command today, right?
Absolutely. And one of the element when we were talking about the cement company, Birla's acquiring a 23% stake in India Cement. It's one of its subsidiaries, CSK.
That's right. Yeah.
But it doesn't come to our mind easily. But as you see, there would be some other steps that can happen going forward.
So there are various related aspects there in an industry like this, which actually kind of are going to influence what all other things that you analyze. Now, they also spoke about, you know, broadcasting rights and things like that. If you were to move on and see how viewership of IPL has evolved over a period of time, over all the years, right? Today, possibly it will be fair to say maximum of the audience view the IPL on an OTT platform, right? Wherever it is broadcast, rather than say on a normal channel. So that has actually brought into focus the fact that OTT as an industry, where is it today, where it is evolving, and how it's going to go going forward, right? We've also seen various trends. There are some instances of consolidation happening there also recently. So I would like Darpit to cover, you know, some aspects on OTT as an industry. If you are as a valuer evaluating that, you know, how would you tend to go about? What are the finer nuances that you need to actually look at?
Sure. But I think so taking cue of the IPL and so how the OTT platforms can be divided would be, let's say the platform like Jio Cinema or that of Hotstar, which is in a way hybrid, but in a way AVOD, that is called advertising video on demand. Their model is mainly to focus on getting subscribers, in a relatively cheaper way, but to earn income by way of advertising. And whereas let's compare the second platform would be that of subscription video on demand, which is pure play subscription model of Netflix, where they mainly earn revenue only through the subscription business. There are other also, which I would just say that it's transaction video on demand, which is like, you know, Amazon Prime, you will see there's a rental model, or YouTube is a rental model, and obviously hybrid. In India, when I take IPL or Hotstar, Jio Cinema and Hotstar would come in the hybrid model, whereas Netflix or ZEE5 may come in the subscription model. Now, what's the strategy? The strategy of Jio Cinema or Hotstar would be that today, if you look at the Indian market, if they want to penetrate, there are two India. One is urban and one is rural. Rural are very price sensitive, and they would not like to enter just by giving a high premium, and hence it is easy for them to keep a lower subscription price. At the same time, by putting advertisement revenue and by taking this IPL rights at a huge cost, they win more subscribers and they make money in advertising. Now, as a valuer, how we look at these business models, or if you want to analyze business models, let's say if I want, the focus is very simple. You go focus on subscribers, number of subscribers on a month-on-month basis, on day-to-day basis. How is the ARPU, that is average revenue per user? But what's important is to also understand the operational part of the business also. Let's say if you compare Netflix, ZEE5 or any other content, and if you want to rate their content, you should find out other ratios also. So, I mean, we do sometimes the lifetime customer value from one subscriber and divided by the cost, the customer acquisition cost. So CLCV to CAC ratio is quite common. This will allow you to understand the premium that they are getting from one subscriber. Also, you should see what's the efficiency in terms of their content. So, you know, we can also see the ratios like what is the content utilization rate, that is how much is the spread of the content getting used in terms of number of hours and divided by the total library. These are the key ways, or churn rate, or even you find out the reactivation rate. That's a typical model of a Netflix or a ZEE5. Now, if I go to a more expensive way is on IPL rights or the T20 rights, they spend a huge amount of money. It's almost $3 billion to achieve one broadcasting rights only of internet. The idea is to penetrate the market, get the subscribers, and they bundle it with a lot of other content. So if you see Jio Cinema, they have huge amount of content. They give all the choices of televisions, and that's how they are trying to penetrate and make money. Here you will have to focus on the engagement rate. whether the person who is also watching the IPL is also continuing to watch during the non-IPL season, and what is the length of their engagement. Let's say Hotstar, the television channel, what is the engagement rate? What is you will also find a difference in monthly active users and daily active users. The engagement ratio will change. So it's very fascinating. I mean, the OTT platforms are very interesting model. Globally, subscription model is facing kind of a slower growth than what was anticipated since 2007. And I mean, the trend is to go towards a merger of, like how you see JioCinema getting Viacom, getting all the content into one place, or Disney and Fox coming together. So that's something which we are seeing these days. And the valuer, you have to focus on all the efficiency ratio before even agreeing to a projection. Ad load factor. Now, suppose somebody just increases the projection of advertisement and just increases the ad load. Ad load is like the amount of time you can give to the advertiser. They can increase the ad load factor and increase the revenue, but that doesn't, that should be corroborated with the past or the market rate. So all these elements become very crucial in an OTT valuation, and as a valuer, probably we may get limited data in the public. So it's important to ask the client also sometimes to do the survey or map it and give it to us in order for a valuer to comment whether this is actually a quality product or a non, how to rate the quality of the asset. These are just some.
So which means, those aspects like Darpit rightly mentioned, although on a spreadsheet they can project that ad revenue can go from X to Y, but that there is only a limited amount of time that you can rent out ads for, right? So as a valuer, that kind of analysis becomes much more akin to, let's say, if you were valuing a manufacturing company, you're looking at it from a capacity perspective. Your time is in a sense a capacity, right? So Pinkesh, maybe just taking a cue from what Darpit touched upon, aspects like what is the strategy of that OTT player, whether they're going for, initial free subscriptions so that they get more user base here, or whether they go for a premium, model, subscription-based model. That along with the fact that what is the content library and the rights library of that OTT player. Both of these, are they going to be, one of the key aspects that you look at when you're valuing an OTT player?
See, what is OTT player? We've all been part of the cable TV.
Right.
That was also something new from Doordarshan, right?
Right.
So it's exactly a next step to it. And I will add to it, on top of it, is India is a price sensitive market, including some part of urban. Let me put it that way. So it's a price sensitive market. So to that extent, unlike in global markets, which is US and other developed markets, they are happy to pay a subscription and get an uninterrupted supply of whatever they wish to see at whatever time they wish to see. Unlike that, in India, it's more going to be an advertisement-led thing. It's very classic. The newspaper that you buy of 5 rupees, if you give it to the Raddiwala, it's going to be, you return, that much. Same as with the cable TV, the advertisement. So in India, the market is very clear, the businessmen are very clear. They have to not take it from the customers directly, it has to come through the advertisement. So that's the primary thing. Second, if you see, as many businesses have matured, we've seen telecom, we've seen modern retail, we've seen internet, .com bust, everything. Over the period, even OTT has matured. I can understand, we can break it up into pre-COVID and post-COVID scenario, how it has worked. They paid a lot of money, they invested a lot of money for customer acquisition, for building the content library and customer acquisition cost. However, today if you see, you look at all research reports, whether it is for Netflix, Disney, or for that matter, what is happening in India. And it's not very different from the cement industry consolidation. They've seen initial 10, 15 years of investment, the growth is plateauing, so now consolidation is on its way. You see many of them have consolidated, Reliance has acquired some other people have acquired the platforms. So it's and globally also it's happening. So to that extent, it's going through the same phase of consolidation, same phase of maturity at this business level. And so to that extent, if you see, Netflix would have said from $50 billion, we want to bring down the cost by 10%, which is $5 billion. which is a huge number. For all the people who create the content, it's a killer. Same way, the other options is, from a pricing perspective, they're not able to increase the price, because the moment they tested it with increasing a subscription rate, the number of subscribers went down. So it's a fine balance that they have to do globally. In India, it is very clear it's a mass product.
Users won't pay.
Users won't pay. You get it from the advertisers. Like a newspaper, cable TV, this is
But
also
you
gonna
need
be
users
the-
so that advertisers pay.
that for that you have to keep on adding the content. But again, the content, as I said in the earlier, is intangible. One could be a Three Idiot, Jodha Akbar, the rest could be a basket of products which don't work, or their content may not have the best of the appeal. And it loses its appeal over the next 5, 10, 15 years. The classic case, all T-Series, Shemaru, all have Saregama, they have a huge library, but they don't enjoy the same royalty income which they used to do it in the year 5th to year 10th and 15th. Even how many times you'll want to see Sholay again? Yeah, you'll go to Three Idiots and then to new movie. The price that you pay keeps on going down. So these are the issues which one will have to also
So
keep
which
in
means
mind.
although today there are possibly 8 to 10 players in the market, maybe 2 or 3 are well known, the others are relatively not so well known and not so used. Going forward, it's more likely to be like a telecom where you're going to finally end up with only 2 or 3 players, right?
Then only they will be able to raise the price. You are addicted to it, so you end up paying it.
Like what happened recently with telecom.
Yeah, yeah. Just coincided with the wedding.
Yeah. And people are saying they're financing it. Anyway, so I think we've covered good ground on another sector which is as interesting to all of us as it can get. Right? So, can't hear. Can you hear me now? Hello. Can you hear me now? Yeah. So we've covered, two very, very different and interesting sectors, and we also covered a bit earlier on how a merger valuation is different than normal valuations, right? I'd like to move to a slightly more related aspect now, which is valuations for and related to financial reporting, which has a lot to do with what investors are looking at, right? We all here spoke about strategies of companies and also strategies of investors who are holding interest in the company as to what are they looking at, when do they want to exit and all that. Among the investor fraternity, AIFs, alternative investment funds, obviously are one of the key, value drivers there. I'd like to get Snehal in here where, there have been recent developments there in terms of valuation requirements for AIFs. SEBI has brought in various nuances there as to, other than who can do valuation, they also have specifications on what are the guidelines to be followed, what are the things that are specifically required to be disclosed in terms of thresholds for how the value moves within a year, whether it has moved beyond a threshold or not. So that has obviously kind of brought in a lot of new challenges in that industry, so to say, from a valuation perspective. So Snehal, your thoughts on that?
So the circular, which got effective on November 2023, got a lot of slight chaos also, because there were a lot of things, because how regulated or how standardized they were trying to get the private equity industry, or trying to get everybody on the same thought process. While our Western counterparts have had set of guidances and guidelines and more slightly regulated, we, I think, have taken that initiative with this standardization that the attempt has been made at. Of course, they were about responsibilities of what the AIF managers are supposed to do, how are they supposed to look at their investments, not just from a valuation perspective, but even from a compliance of how they're supposed to keep reporting to the SEBI, and who would be doing these valuations, what are the qualifications required. It was kind of slightly changed and articulated in this circular. Again, there are a lot more responsibilities on the AIF managers here when they're looking at communicating with the investor and the regulatory authorities. I think, and from a valuation perspective, this has definitely helped because before, one of the challenges we could see was before the circular came in, there were a lot of methods people are talking about. There were a lot of more commonly traditionally accepted methods which were doing the rounds. But this did spell out like you would look at more internationally accepted methods, more industry-aligned methods to be specific. We've all heard, just to give an example, we all hear the word PORI, price of recent investments, very, very famous, very commonly used, because there is a round done and, you know, okay, let's just take that number, you know, and that is the value, that is just 2 months or 3 months ago. But like I even said before, and what, you know, our colleagues also said here, when you're looking at these kind of investment companies, investee companies, what it does is story the narrative. It changes, it's dynamic. You could have entered, a fund would have entered at a particular date with a particular vision. It could change. So you may take a price of recent investment, which from a very technical point of view would be correct. But a valuer has to sit back and think what has really changed from that round. Not just take that number and say, oh, it's check in the box for me, that is my value. Because a lot of times, this is what I say, it's a sort of FOMO. People want to keep on investing because they feel they're left out from a round, and it keeps on happening. You will see up, you know, numbers going up. But again, we have to go back to the fundamentals. Where is the price discovery happening? Who is doing it, and what rationale is that happening? So these questions need to be asked. And I think the standardization, while the methods are there, has also spelled out certain really good concepts for us to discuss as calibration. When somebody entered, what are you really calibrating it to? Because end of the day, when you're talking about financial reporting valuations, the underlying premise here is fair value. So while the transactions happen from an investment perspective, from a reporting perspective, the fair value kicks in with a market participant. And this is the difference we see. When an investor's going in, he's going in with his own specific agenda and a number, and what he's going to draw out of it. But when you talk about fair value from a financial reporting perspective, it's how a market participant review, and there could be various of them. So there again, what these methods will do, of course, your standard methods are your, you know, income approach, your cost approach, and your market approach. Your PORI is something like a preceding round. But it's important to see you're trying to dig deeper into why the round happened. Yes, there are constraints in terms of information where they'll be available. Sometimes you have to read between the lines, you have to go to, there are definitely several databases that you have to track. So it's not like I have a model up and running, I'm just gonna tick the box and it's gonna throw up a number. Because I'll tell you where this comes to a standstill or a conflict sometimes, is when there is an auditor. There's a year-end process, right? And the auditor definitely has a responsibility as well of trying to, substantiate, okay, what procedures they've done, and they've understood what the management of the AIF and the valuer have tried to put in the method. Again, like any method from valuation perspective, your consistency is the key. Your methods have to be consistent with what's the operations of the company, the industry, like we've definitely heard about the industries earlier. So when we talk about this, we've seen again from an auditing point of view, when we are reviewing these valuations, and there are several data, automated platforms. We've heard about Kata. It's pretty, used in the West. Of course, there are a lot of them who are using here in India as well now. They are pretty much automated. You punch in the numbers, there'll be a set of comps that throw up. It's also important, just from an example perspective, you're talking about comparable companies. When you're using a software as a service as opposed to an individual evaluation professional entering into and discovering what it's really doing, the difference that we've observed so far is a Kata report will throw up things based on a very broader perspective. But as a professional appraiser, when he or she sits at it, you'd ask those questions. Okay, who's my market? Who are my customers? Where are we at? How are we growing? What's the plan? It's very difficult to embed this in a software-based platform kind of a thing, while when you're doing it on a model and understanding everything, it can be differently modeled out. The challenge here is how the AIF manager, the auditor, and the valuer, all three of them can sit and come to a consensus vis-a-vis the investee company that they're looking at. Another thing that we see is, availability. Again, substantiating all that. We understand that, there are various reports, there are various, industry reports that we can substantiate it with. It's very important that all three talk to each other, because when there is, we've also heard like this is the way we do it. That while could come from a fact that it's traditionally accepted, it helps even the other person to really understand, because from an auditor perspective, they are also they are responsible to be compliant with certain checks that are there from their regulatory authorities. And from an investor, it's important to know where my money is parked at, how is it flowing, and that communication is very important. So when these annual, they could be annual, they could be semi-annual, or they could be quarterly exercises, depending on how small or big these AIFs are. It's important that you use methods consistently and track them. That's calibrating it. You track them from how or why the deviation is required. I think once you have this framework in place, it helps the whole process. And that's the key aspect the SEBI circular came up with.
So you think the circular has in fact helped in standardizing the methodologies that valuers using for AIFs?
Yes, definitely. Because there are also the IPEF guidelines. While, it does not say you exactly do this, but internationally there is the IPEF guidelines. I think in December 2022 is the latest publication. There's also another counterpart, if you want to really see of how valuations can be done, is your ASC 946. This is a US GAAP. They also have a very huge text. Again, these are non-authoritative, the IPEF guidelines, but absolutely sets the benchmark in terms of how to view them over a longer period. Because when you're entering, you're not looking at an immediate exit. So it gives you that framework to work around it.
So from a methodology perspective, I mean, what is the most frequently used method you would have found that people use to value investments of AIFs? In general, there is no one-size-fits-all approach, in general.
So the smaller ones, again, depending on what stake they're acquiring, right? Because again, the VCs, if we start off with, they typically end in with a 5% max out, or a stake, the ticket size, what they call. They would probably peg it to just the cost and say, okay, it was very recent. This is all the information available. But that's a very critical point, is the data availability with the investor. If you're someone with a minority stake, like a 2% or a 5%, and the biggies come in later on, you do not have, because again, it's all coming back to your agreements, how they're drafted. When you're entering into that agreement, it depends on which round you're entering, what are your rights as an investor, what access do you have. You might, get only information at the year end, okay, this is what our company is doing, these are the audited statements, that's it. From a valuation, that's a critical point of view. If you don't have too much data available, you would have to see what the others are doing, which is pegging it, relative valuations, or their preceding transactions. Somebody else has entered, okay. How can you plus or minus certain things specific to your adjustments and come to your value? So like you said, there is no one size fits all. It all depends on what information are you privy to.
So the market approach would take more precedence when you don't have so much companies.
More common, yes. More common, yes.
So availability of information also could be a challenge where the investors don't hold significant stakes in the company, and you are, as valuers, are still required to value that investment. So because of the minority stake, they sometimes don't even get the latest financials of the company, right? So
yes,
that could be another challenge you face. Projections is a far aspect there. So that's a challenge that can be kind of encountered, and you can kind of solve it by using the market approach and other related aspects of market. So Pinkesh, you would like to add anything on the circular in specific, and also in general valuation of investments of portfolio of AIFs?
No, I think particular to this, Snehal covered it very well.
Yeah.
So from that perspective, approaches are, she also covered it with its calibrated PORI, market approach, non-availability of latest information is obviously the case. Otherwise, methodology is standard, and we have to, as the dictate is, we have to follow it. That's it.
All right. But another challenge, so Darpit, you want to add anything on that? Another challenge that is kind of unique to the AIF industry or the investor community, so to say, is that whenever they invest in these companies, right, the agreement is obviously huge, and there are so many nuances put into the agreement. So they have aspects. They have aspects such as put option, a minimum IRR, an exit clause that if they're not able to, if the company is not able to give an exit, the promoters have to give them an exit at so and so price. The minimum return that they end up making should be say 12% or 18% or whatever it is, depending on the nature of the fund. So these are clauses that are very unique to an AIF investment, or so to say a PE or a fund investment in a company. So when you're valuing Snehal, when you're valuing such a company for an investor, which has these kind of clauses put in place in the agreement, how would you kind of consider these kind of aspects in your valuation?
So we've seen this commonly, and just the recent example in one of the digital first consumer product company that we work with as well, and just in general how these terms come up. After an acquisition, of course, the reason is you'll see a lot of call and put options in there. While you could do a step-up acquisition, there will be a call and a put clause in there that, okay, if you achieve a certain EBITDA or a certain revenue number over the next 2 years, it's more to put even the responsibility on the founder, because while it's a negotiated round, we all also do understand that an acquisition, especially for startups or something, is more of a negotiated round. And you want to invest and believe in that idea that it's possible. These clauses come up, and one of the best ways is to have these call or put options where either of the parties say, okay, if you achieve a certain milestone at the date, and we'll keep tracking it, this is the extra or additional consideration that you will get. Now, this consideration can be form in cash, or it can be form of the exchange of shares as well. And the way you go about valuing them is, of course, there are different methods as well. Your, Black-Scholes model is there. Your Monte Carlo is there, because what these models do, or binomial lattice model, they're a little slightly complex, but what these models do is enable you to build in these possibilities, and vis-a-vis your market data, your comparable companies, see how they are moving, the volatilities. You're able to at least ascertain with reasonable assurance. We cannot say this is absolutely going to happen, but there is a reasonable assurance there from a valuation perspective that, okay, there is a possible that this could be, therefore there is value to this call or put in the first place. So it's important because your accounting standards also require you to account for these, hence the valuation is very important. And the challenges here is, again, the data, the inputs, the industry you're working with, and what's the underlying rationale of those agreements. Another example that we've seen, and I was talking about earlier, was the SPAC. And there is something that's we've seen again more common is a forward purchase agreement. And they can be slightly articulated differently, but the rationale here also is when someone's investing in you and they're going to look at an exit, they're assured in a sense a certain amount that, okay, you wouldn't make an absolute loss. This is the company's responsibility either to buy back the shares at a certain predetermined number, or based on certain market conditions, you would get an exit. Now again, these models, you'll have to look at one of these three: option pricing, Monte Carlo, or a binomial lattice. More preferably, what we've seen is a Monte Carlo. Again, the estimates here are your market participants, your comps, your volatilities you see, but also the essence lies in the agreement, how it's really drafted, because that can really change the liability. Because again, there is something called as determining first whether it's a debt instrument or an equity hybrid. What are we really looking at? The accounting standards guide these valuation principles for you in a sense, and therefore you have to know these complex models, because that's the only way we've seen so far that these can be modeled.
So what I hear is, wherever there are these kind of clauses, whether be it a call option or a put option, use of option pricing models is one way where you can kind of come to a reasonable conclusion with maybe a science behind it to ensure that you're at least closer to what is really going to happen, right? So most of these clauses are generally put so as to protect the investor, right, in some sense or form. So like Snehal said, it's very important to ensure that you know what is the background of that clause, why are they putting that, and what is likely going to happen, right? Sometimes there are even the reverse clauses, right? So there are agreements where you would see possibly there's a cap on the return. And if the investor ends up making a return beyond that cap, he needs to share that return back with the promoter. So do you as valuers see those kind of clauses also and incorporate in the valuations in the portfolio when you do this?
So there is a ceiling and a floor,
Yeah.
of course, and those
Right.
models will capture those ceilings and the
So it
floors.
will
I
capture
think.
both the
Yeah,
ceiling as
yeah,
well as the
yeah,
floor
yeah.
to ensure that you're ultimately in the spectrum in which reality is going to actually lie. It's not going to go beyond what is legally even permissible, that they end up making a more return that they're entitled to, right? Yusuf, so she also touched upon the fact that sometimes investors keep on investing just because of FOMO. They don't want to miss out on that round, right? So we've seen so many cases earlier where people keep on investing at the same price or maybe at a different price, but which was actually agreed some time back. So do you think actually those kind of things are something when you are, let's say, ascribing a value to that company today, if this round is happening, you would actually look at that round as a fair indicator or no, especially when it was actually agreed long back?
No, so this is a real challenge because the
Yeah.
point that is there is that, you know, today when you have got a back agreement, obviously you're bound by it in a particular sense.
Right.
And the problem that is there is that, really speaking, you're allotting the shares today. So, you know, you may have a floor or a cap in terms of a particular price that is there, and it works both ways. But from a regulatory perspective, and I think this is where the challenge would come about, is that, you know, you will not be able to do certain things that you would otherwise wish to commercially.
Right.
And that is where the balance or the alignment needs to take place, because the investors will say that, look, as an early investor, I need to be given a preference. And effectively, if you are doing a second round at a price lower than, you know, what you've sort of offered to me, then I must be given the benefit. If it is higher, then my investment should be capped at that amount. So this is really the challenge that one faces in these kind of situations.
So as he rightly said, you know, whatever be the commercial negotiation and whenever it was agreed, from a regulations perspective, it is very essential to ensure that it is compliant. So if suppose we are appointed as valuers for that, then that valuation has to be independent of whatever has been the discussion, or whenever the price was agreed, you're anyway as valuers required to, you know, arrive at arm's length or whatever you call it, fair value, right? Based on the conditions existing today. And if that value justifies the price, then that's how it becomes regulatory compliant. So I think that we covered good ground on the financial reporting front, and kind of we'll use that as a segue to move to our next segment, which is the regulatory aspect of valuation, right? One, we spoke of AIFs and all that, but another important thing that has kind of developed in India over the last few years is infrastructure, right? And within infrastructure, there are various structures obviously developed to monetize, and one of the important developments there has been InvITs, right? So InvITs are quite common now, and it's a sector which is kind of pretty large now. There are many InvITs that keep getting listed. Valuation of InvITs is again a specialized field, and there are SEBI regulations as well which govern that. So I'd like to bring Darpit in there on his views on how do you as valuer would get into valuing an InvIT investment, and what are the methodologies you'll use? Are the methodologies also kind of driven by the regulatory requirement, or are you free to use what methods you would generally use?
Sure. I think just to give a brief about InvIT, what is an InvIT structure? It's very similar to a mutual fund where institutional investors and individual investors invest, but the investment has to be in infrastructure assets, and those are 100% completed assets, and they get in return of a semi-fixed return, and that's called yield. That's a dividend yield or in the form of interest from the trust to the unit holder. Now that's one aspect of the structure. The question now is, as per the regulation, there are two elements. Now you have to value the InvIT assets as per the regulation, and there is second is valuation of the InvIT itself. So let me go to the valuation of InvIT assets. This is driven by SEBI regulations, which requires all the InvITs to value all of its assets on an annual, semi-annual or quarterly basis, depending on the category of InvIT they are belonging to. And how to value these assets. Just to give you a context, in India today there are 21 InvITs. All of them are ranging in the infrastructure sector, dominated by road assets. In road also there are toll assets, which everybody must be knowing. There is also called annuity assets or hybrid annuity assets. Then there is power transmission assets, and there are other pipeline assets, even logistic assets. The question is now how to value an infra asset. Just to compare how infra assets are different from a normal equity. Infra assets is a limited life. They are driven by the contractual asset. Let's say a toll asset is only for 15 years. After 15 years, the company has to give back the asset to the government. These are called build, operate and transfer models. There are also like transmission lines which are on boom basis, which is called build, own, operate and maintain basis. So where the maintenance is also for almost 25, 35 years of life is given to the operator. What's the good part about an infra asset is, especially if it's an annuity asset or even a hybrid annuity assets or transmission assets, the entire cash flow for the lifetime is actually given in a black and white. There is a complete transparency in terms of what is the likely revenue on year 1, year 2, year 3, and so on and so forth. Also, there is a good visibility on the expenses. How to operate a road asset. It's not a rocket science. How our transmission lines are operated. All these are very feasible in terms of, or foreseeable in terms of what is the likely expense. And if you'll be surprised actually if you compare how the projections and actuals are meeting. It's very near to 98% or very near to even 100 or something that percentage. So that's a good part about the infra assets. So what happens is these all factors are very unique to an asset. You cannot compare a road asset of Mumbai-Pune Expressway to that of let's say in Gujarat or let's say Jharkhand. It will be very different. Every asset is geographically located. They have different climatic conditions, different operational parameters. One may be a concrete road, one will be a bituminous road. It's very different. So very difficult to compare two assets, but there are ways to corroborate or cross-check it. So most of the time, the InvIT assets that we've seen are valued as per DCF method. And the projection, as I mentioned, is foreseeable and you are able to check it. What is the challenge when you do InvIT asset is actually the risk factor. Today in India, you will see very few, only 4 publicly listed InvITs, and that too, not all have completed 5 years also. So the beta that you want to find out or the risk pattern that you want to find out are not available. And if you take an infra comparable like L&T, or if you take a comparable of all these road companies, risk is actually of the EPC business. The risk is business of under construction asset. It's very different than what a completed asset is. So the biggest challenge when valuing an InvIT asset is the risk that you determine to a completed asset compared to a EPC business. And that's where the job of a valuer comes in to pick the correct comparables. We've seen the valuers have also given subjective discount in a minus percentage to agree that the risk is quite low in case of a completed asset than a under construction. So, but the good part is now the InvITs are there which are giving their beta, and there are probably some InvITs which have completed 5 years also. So that's the sum and substance of how the InvIT assets are valued. Just to add in how InvITs are valued. Now that's a different aspect. All these InvITs are basically nothing but summation of, let's say, 10 projects in an average, or 20 projects sometimes. So you do sum of the parts. You add all the assets, you bring them to a total value, then you reduce the debt, which is at a console level, and also you have to reduce the expenses of the trust, which is likely, and then you come to the net asset value, and then you arrive at the InvIT unit price per unit. The second obvious question is that since the model looks very complicated, but in substance, the investor is asking for a simple thing like, I'm investing 100 rupee, how much are you giving me? 8 rupee or 9 rupee? And hence the concept of dividend discount model also comes in. But it's a very simple way to put it across, probably not a correct way to value the InvIT. I mean, in the relative terms, a more scientific value would be sum of the parts in a DCF, and that's why you see most of the valuers are taking InvIT valuation with DCF approach.
So is this also driven by what the regulations require, or regulations don't mandate any specific method?
Yes. In fact, there is an entire section in InvIT where the SEBI has given all the instruction about mandatory disclosures. In fact, the disclosures are very unique. They will ask you to even describe what's the project details, whether you have done the site visit. If you've done, put the pictures of the site visit. Also, you have to also mention all the material litigations, all the licenses, approvals, and it goes in pages. The approvals goes in pages.
So these disclosures are for the valuer or for the InvIT?
For the valuer.
For the valuer, right?
The valuer has to give it for each and every project, mind you. I mean, it's really tedious, but it's in a good spirit, because probably if I take you, it came after the ILNFS fiasco, and probably the reason would be to give better disclosures to all the institutional investors. And it's really encouraging to see all the disclosures are taken care in the good spirit. Also, one of the another reason, another disclosure is very important is it is given in a very simple line that you have to give all the material disclosures that a valuer is used for arriving the valuation. So that means you know how to interpret that. So all the valuers are given entire DCF, entire WAC, every element that is material to the disclosures, it goes in the report. So actually, if you see all the 21 InvITs, you will find a very comprehensive valuation report available.
So it will be fair to say that methodology is not so challenging,
Yeah.
but following the regulations and complying with them to ensure that you're not kind of on the
Yes.
wrong side of it, that is where more of a challenge lies in case of value in InvITs, right?
Yes.
Okay. So regulation is challenging is something that is not only unique only to InvITs. Another thing that has been making the news always over the last few years is angel tax, right? Again, a part of regulations, not so famous. Recently, there have been developments where they've kind of tried to streamline it and also widen its base to ensure that it also covers, various, including issues to non-residents and stuff like that. Various methodologies are allowed. Who can value has been, defined there specifically. But what has been consistent is the fact that for every such transaction, there are various different aspects of different regulations that companies need to look into, right? So for any single fresh issue of shares, we've seen sometimes companies requiring 2 or maybe even 3 valuation reports. One could be for a tax purpose for angel tax, the other one could be for a Companies Act purpose because it's a preferential issue, and the third could be for FEMA because it's a cross-border transaction, right? So that is a challenge that companies, irrespective of the sector that they are in, kind of keep facing depending on the structure that they adopt for the transaction. So Pinkesh, is that something that we as valuers, how do we kind of tackle that when you know that there are different regulations, each of them requires you maybe to follow a different method sometimes, and each of them has a different agenda in terms of one is a floor, the other is a cap, the other is a fair value, right? So how do you kind of, I'm sure the challenge that the client faces is much more than what you as a valuer face, but your thoughts on that?
No, complexity brings business.
Yeah, for professionals.
For professionals. But of course, it's very difficult in terms of when a client is about to close a transaction, there are much more critical elements of negotiation, discussion, legal documentation that needs to be taken care. Against that, they've been given a list by their advisors, 3 reports, valuation reports required, one from registered valuer, chartered accountant, merchant banker. The valuation date for all the 3 of them or 2 of them could be different. The outcome of that or the date of valuation also is going to be unique. In one of the case, they will say as on the transaction date, which is not practical at all. But still they will mention it's as on the valuation date. It's not even a month earlier. The date of valuation is different. The premise of valuation is not consistent. And in terms of when the report should be taken for a transaction and whether who should take, whether the buyer, the company, seller. So all of these adds a big quotient, a question mark to ease of doing business. That's the way I would look at it.
But you started with saying that it brings more work for professionals, right?
Professionals. I'm talking about if I take care of my client, then they will get more business.
So Darpit, your thoughts on that?
Yeah, I think it is like, the first question the client says, how many reports I require, and it just takes at least 15 minutes to explain him that, okay, it's a FEMA requirement, it's a minimum price, maximum price, then you have income tax saving, okay, you have to take it from merchant banker, you have to have it from CA, then you have another RV valuation. He said, now how many reports you have to take? And obviously, as Pinkesh mentioned about valuation date, things becomes more complicated when it's like contingent consideration. Now, FEMA doesn't allow you a percentage above contingent consideration. So the element
way of showing us off.
Because the noise is getting louder and louder.
Put a timer there.
This is the main problem. It's been a pain point for a few of our clients as well. Sometimes you also have very basic question of if a company is trying to, invest in a company abroad through its subsidiary US. Suppose a company A has a subsidiary in the US and they want to acquire the company B, who's also a US company. And the question comes is, okay, किसका valuation करना है? But they forget the target. Why
So,
they're
so
acquiring
valuation
the
date is later. First question is
so
kiska
I
valuation
got
karna?
this question and it happened very common, and we were wondering what is it that the client's missing, and we have to sit and explain that. Look,
Right.
this is what the rule is. So there are those basic questions also.
Yusuf, your thoughts on that? Closing thoughts, so to say.
So, it's the way I see it is that once you got the bride and the groom to agree, now you have to get the parents to agree. So that's the way that I
The
see
difference
it.
is here there are too many parents. Right?
Correct. So parents of both sides are there. So there are too many parents. But the way particularly when I look at this tax provision, which is in terms of your 56 to 7B, I think it's perhaps the most ridiculous provisions that the government has introduced. I mean, today you have, two people agreeing on a commercial valuation. I can understand your concern if you are issuing shares to your associate or your holding company where there is where you are in a position to influence the price. But when you have an arm's length transaction, somebody believes in the business idea, somebody believes in the story, and they sort of invest money. And then 2 years down the line, you have the tax authority saying that, okay, now substantiate the valuation. I mean, it's not fair. It's completely unfair because nobody has a crystal ball. I mean, today nobody knows what are you going to do 2 years down the line. And then to say that, look, your valuation is highly unjustified, it makes no sense to anybody. So I think that's the way that one looks at it. And of course, you have this constant conflict that is there between FEMA, because when you're sort of issuing shares to non-resident, it has to be at a price which is above the fair value. When you are sort of, making an investment overseas, you cannot invest at a price which is higher than the fair value. So, and then you have, at the end of the day, SEBI, also to be taken care of when it comes to listed companies. Not only that, so when you look at listed companies, particularly when it's a merger, once you've agreed to a price, you'll have a registered valuer that is there. You then need a fairness opinion. And that fairness opinion also has to be in sync with, the value that has been recommended by the valuer. So I think Pinkesh has summed it very well, that it's not only good for the valuation business, it's also very good for all your other segments. So tax,
Right.
account, everything is going to flourish.
And it'll be fair to say that the reason why any such unfair regulation comes in is because someone somewhere has possibly misused a fairer regulation. So to avoid that kind of misuse is where I think all these regulations are coming in. But sometimes the complexity there kind of kills the entire purpose of that, like possibly it has done in case of this section. So I think we're broadly kind of covered whatever we wanted to cover. Any questions or thoughts from any of you guys? Yeah.
So I have a company in which it's a private limited company wherein a secondary market transaction has been done in 200 crores, and there was a sale of 10% equity shares which was by a single party which was bought by 10 people. So in this case, the majority shareholder who bought my majority shares, he took a valuation and he said he will give that valuation certificate to everybody for their records. Now the same company is doing a primary round in September, which is going to be at 1300 crore valuation. So the secondary round was at 200 crore, the primary round is at 1300 crore. And I'm wondering that after 3 years, the income tax officer might get up. If he gets both the certificate, he will say, what is this going on? So the secondary round, there is a indirect gain to the purchasers, so it would become income from other sources, and you pay taxes on this. Will that be the case? Or will the people really be able to say, I have got a fair value report and I'm fine?
So I'll just take that. So, it also depends on whether the shareholders who are disinvesting are residents or non-residents, because there's a different nuance to. So if they are residents, then frankly, you are looking at only tax, essentially. So when you are doing a secondary transfer, all you need to do is your price is above the tax-adjusted book value. So your fair value is your tax-adjusted book value. So long as your transaction is above that value, you should be fine from a secondary transfer perspective. The problem that is going to be there is that when you are doing your primary issue, okay, how will you justify the premium? And that's the crux. So you could get stuck over there.
Actually the primary valuation is the correct value.
No, so if the primary valuation is something that you can substantiate, then you still have a good case to argue, because from a tax perspective, you don't need to go above the tax adjusted book value. So I mean, I'm hoping that there are no guard issues here, but other than that, it should, you have a good case to defend at least.
GAR was covered in the earlier session.
Yeah, but,
No, so the only idea of taking that 10% at 200 crore was that size of the company was promised and a return was promised. So that was done. So instead of having a subsidiary, holding company and all the structure, the investor was explained that you have got more than sufficient return. So if you don't want us to break the company, then you give us the 10% back. And he gave us very happily, because he was very happy with it, because he got his principal back, 100% principal back, and he still left with 20%. So that was the whole idea.
Yeah, but in any which ways, the investor who has taken the money or taken the shares is something where he has to justify to income tax. So he has to justify to the income tax after, if at all it comes, that how did you take a 1300 valued amount at 200. So I mean, see, either of the two things in a normal circumstances should be right, either that amount or this amount. But I think let's not go in a very unique.
I understood saying that this is a secondary market transaction, so it can be done at any value.
I think it's a very specific case, but I would say it's.
But I think Yusuf very nicely put it, right? In the regulations, possibly there is not something that you may need to be too worried about as long as it's justifiable, because every regulation is different. Tax for a secondary just talks of tax adjusted book value, you are compliant there. As long as you are complying with the fresh issue price, you should be okay, right? Specific numbers obviously are very different, but in terms of concept, yeah.
So I'll just sum it up, ma'am, by saying that technically defendable, practically challenging, good business for you.
So the timing of the two transactions and the percentage stake on the deal between the two, those you need to check.
No, it's for you. How you evaluate it.
No, so initially we said we will not take since it was a secondary transaction, we didn't bother too much. But then later on I stepped in and I said, boss, you at least take the valuation certificate for both the things and take it from different valuers.
One will not be able to give you.
The primary transaction you have to take it from a merchant banking.
Even if you go to a firm which has all the license, has to be different. They won't be giving you.
So I'm not allowed to ask whether there are any further questions. Or standing there.
The mic will also stop.
No, but thanks a lot everyone for your time. I would, on behalf of WIRC of ICI, I would like to thank all the panelists, Yusuf sir, Darpit sir, Pinkesh sir, Snehal ma'am, and Devarajan sir for being the moderator. I think we have been given the approach to valuation through all the discussions that we have had, and it was indeed a great session. Thank you all, everyone. We would also like to thank the organizers for this wonderful conclave, and most of all the participants for the active participation and making this program a success. Thank you all very much again, and hope everyone has a great weekend ahead. Thank you so much. Thank you, sir.